Two numbers came out of China this month that describe two completely different economies. The first, China's semiconductor exports nearly doubled in the first half of 2026, surging 96.1% year-over-year to hit a record $177.28 billion. That is the kind of number that gets held up as proof China's tech industry is unstoppable, riding the global AI boom straight past any Western attempts to slow it down. The second number, released in the same stretch of July, says fixed asset investment inside China fell 5.7% in that same first half, and the broader economy grew at just 4.3% in the second quarter, the slowest pace since late 2022. One country, one 6-month window, a record-breaking export boom and a shrinking domestic investment picture. At the same time, let us sort the signal from the noise. Look at the export number on its own first, because it is genuinely large. Chinese semiconductor export value hit $177.28 billion across the first half of 2026, on shipments totaling 179.44 billion units, a 96.1% jump from the same period the year before. That kind of growth, in a single component of a national economy, in a single 6-month window, is rare, and it lines up with a much broader trend. Global data centers scrambling to buy chips for artificial intelligence workloads, driving demand for memory and processing hardware to levels the industry has not seen before. China's exports have leaned specifically into that demand, and the raw dollar figure genuinely reflects a real, measurable surge in how much semiconductor material is leaving Chinese ports and factories, going out to customers building the infrastructure behind the current AI build-out worldwide. Now look at the number sitting right next to it that tells a very different story. Fixed asset investment, the combined spending by government, state-owned firms, and private companies on factories, infrastructure, and property, fell 5.7% year-over-year in the first half of 2026. Property investment specifically dropped 18%, continuing a slump that has weighed on China's economy for several years running. Private sector investment fell 8.5%, and even state-owned investment, typically the most stable of the two, slipped into negative territory at -2.3%. Put together, both the private companies betting their own money and the government entities usually stepping in to prop up growth pulled back at the same time. Gross domestic product growth for the second quarter came in at 4.3%, the weakest reading since the fourth quarter of 2022. Confirming that this investment pullback is showing up in the overall size of the economy, not staying contained to one sector. Here is the detail that changes how you should read that 96% surge. Reporting on the export data points out that most of that growth traces back to price, not volume or capability. Memory chip prices, specifically DRAM and NAND flash, have spiked sharply worldwide because AI data centers are buying every unit they can get. And China's exports are priced in dollars. So a fixed number of chips shipped out at much higher prices produces a headline percentage that looks like a doubling of output. The export mix itself is also dominated by memory chips, power management components, and microcontrollers, along with chips that were imported into China, packaged or tested, and then re-exported, rather than advanced processes designed and fabricated domestically. None of that makes the 96% figure fake. The dollars genuinely left with those shipments. But it means the number reflects a global memory price spike passing through Chinese trade data, more than it reflects a leap forward in China's actual semiconductor manufacturing capability. Weigh what both halves of this story actually tell you together. The export surge is real money, real shipments, and a real beneficiary of the AI build-out. But it is concentrated in one category, price-driven, and does not offset an economy where the property market keeps sliding. Private companies are pulling back investment by nearly 9%. And even the state is investing less than the year before. An economy cannot run indefinitely on one booming export category while its domestic investment engine stalls. Exports support jobs and revenue in specific regions and industries. They do not automatically translate into the broader construction, retail, and consumer spending that keeps an economy's overall growth rate healthy. The 4.3% GDP figure is the number that captures both effects blended together. And it is the weakest in over 3 years. Which tells you the drag from investment is currently outweighing the lift from chip exports. Not the other way around. Quick recap. China's semiconductor exports hit a record $177 billion in the first half of 2026, up 96%, driven mostly by surging global memory chip prices rather than a jump in manufacturing capability. While fixed asset investment fell 5.7% and GDP growth slowed to 4.3%. The weakest since late 2022. So, signal or noise? Split verdict. Signal. The export dollars are real and reflect a genuine, verifiable share of the global AI hardware boom flowing through Chinese trade data. Noise. On reading that number as proof China's broader economy is thriving. The investment and growth data collected in the exact same window shows the opposite. A domestic economy leaning harder on one export category precisely because the rest of it is slowing down. Watch whether property investment stabilizes before believing either story on its own. Subscribe for the economic headlines checked against the numbers sitting right next to them. Signal from the noise. Every week.